Great, thank you very much. The last panel of this afternoon, and everybody's favourite topic, as Liz was saying, Brexit. I'll be honest with you, the original panel title for this session was Brexit 2 weeks on. Now it's Brexit weeks 2 weeks after another deadline passes, but here we are, building up to the election. I'd like to introduce my panel to you. To my left, I have Silvia Dall'Angelo, a senior economist at Hermes Investment Management. Next along, we have Kit Juckes, a macro strategist at Societe Generale. And on the far end, Jane Foley, head of FX Strategy at Rabobank. Silvia joined Hermes in October 2017. She's responsible for providing macroeconomic analysis and commentary, as well as non-standard macroeconomic modelling and developing relationships with key central banks and monetary authorities. So that will keep you busy. She spent 10 years at Prologue Capital before that, latterly as a global economist responsible for the team's macroeconomic view. Kit joined SocGen as global head of FX strategy in 2010 for taking on additional roles covering fixed income, credit, and currencies as well, so taking over the world of markets slowly but surely. Prior to joining that, he also worked at ECU Group and RBS and various other positions across the city since 1985, I believe. I hope that's right. And Jane has worked in financial markets and industry for over 20 years. For 7 years, she held the role of senior economist for S&P's MMS. She's been a fixed income portfolio manager and had an 8-year stint as director of FX strategy at Barclays Capital. Jane has been at Rabobank since 2010 as senior FX strategist and head of FX strategy. So very illustrious panel of guests for me. I'll do my best to be like a good football referee, there to enforce the rules, but also as little a part of the action as possible as we have the conversation. But just to lead things off, I want to talk about a story that my colleagues, including Anuja, who you saw on a previous panel, had at the weekend, where they did a survey of 12 strategists and investors on possible scenarios for sterling as we head into the general election. And what they found is that, according to the consensus view, the pound is unlikely to drop much further from where it is now, whatever the outcome of the election. In the base case scenario for the people that we spoke to, it would be an outright conservative win, and that could shunt the pound higher to $1.34 from around 128.70 just before I came down today. The next most likely scenario, a coalition government led by Labour, would send the pound about 1% lower in the short term, but could ultimately bring it higher. That's what our survey found. And the only clearly negative outcome for the pound, according to the respondents, would be an outright win for Labour. It's very unlikely, according to them, but could send the pound down to 123 if that were the case. And lo and behold, today's story, pound rallied after Nigel Farage's Brexit party said that they wouldn't fight against the Conservatives in constituencies that were already held by the Tories. So that gave a boost, taking a little bit of likelihood of Conservative and Brexit party cancelling each other out off the equation. All of that to set us up. What I really want to do is talk about how our panellists see the election, first and foremost, how that will play out for sterling, and then the longer term implications for Brexit. So maybe we'll start over at the far end with Jane.
Well, I think you've got to separate very much the near term to the medium to the longer term, because the way the market pricing is working, and we saw this today, as you pointed out, it seems to think that we get a Boris Johnson government, the Parliament passes the withdrawal agreement, and that's a deal for Brexit. But I don't think the foreign exchange market is really taking on board the trade talks, the part 2 of Brexit. What happens if we get a what happens if we get a Tory majority, or perhaps a Tory government supported by a couple of Brexiteer MPs? What happens if the trade talks don't go too well? And in the last couple of weeks, we've had a couple of speeches from Barnier indicating that if the UK rolls back on regulation, then it's not going to be easy. The trade talks between the UK and the EU will not be easy. And under that scenario, I think the foreign exchange market and all other market asset classes begin to think, oh, does that mean, after all, there is a risk of a hard Brexit at the end of the transition phase, which, of course, as we know, is only at the end of next year? So there's a very short window of opportunity for the trade talks. And I fear that if they don't start well, then the market might begin to reprice what a Tory government really means for sterling.
Interesting. Is that the way that you're seeing it at Societe?
I definitely think there's a longer term story. If you think about Brexit and sterling, I mean, first thing to say is Brexit trades affects sterling through euro sterling, not cable. If you want to know where cable's going over the next 5 years, just try to get euro dollar right. If it goes down one figure every 6 months, as it's done for as long as I can remember, that's going to make everything harder and more boring. But taking that aside, I mean, I do think, what's happened to sterling is it's fallen to close to its all-time lows in real terms. So it's fallen to where it fell in 98. It's fallen significantly lower than 92. In 2008, and significantly lower than 1992, and not quite as low as it did in 1976 for anybody here who can remember calling in the IMF and having power failures left, right, and centre. I've sort of for a long time thought Brexit's bad, but it can't possibly be as bad as 1976. That would be way too stupid. But either way, we can debate whether that's that bad. The market's incredibly efficient. It made that adjustment down to historically really cheap levels for the currency quite quickly, and we've been faffing around in terms of the trade-weighted level for about 3 years since then, slightly doing our heads in on the news, which is sort of the feature of the market at the moment. I mean, I think I'm with Jane in the sense that once we get past this, so assuming we get a result of this election, that's not the end of this story. What I cannot imagine is what makes the pound fall significantly lower than it did in 76 or bounce almost ever. After 1976, we conveniently, by the time we got the money from the IMF, the economy was turning round. Then some genius found oil in the North Sea and everything was good. And we elected a very right-wing government with very aggressive monetary policies. After 1992, the currency stayed weak for about 3 years, and then we had a housing boom that was fun. Then we made the central bank independent, that was more fun, and so on and so forth. The pound went up. Even after 2008, the pound went up eventually. But this time, I honestly can't, for the life of me, see where the silver lining for the economy is out of lowering trend growth by about 0.5% per annum for the next decade. So I'm looking for someone else to give me some.
Well, maybe Silvia's going to be the devil's advocate here. What about all the pent-up investment that we've been hearing about, the companies that have been delaying, waiting for Brexit certainty, the wall of cash that's coming back into UK equities?
So I'm afraid I don't really have a different view to offer here. So I also think Brexit is really a process. So it's not like a one-off event. And it will probably take best part of a decade, probably, to pan out from beginning till a new equilibrium emerges. And accordingly, I will also agree that the currency will probably remain in the range that has prevailed in the last 3 years. For convenience, I focus on cable, but let's say it has been, I would say, remarkably stable between 120 and 140 in the last 3 years, and I think that will continue in the next few years. And in terms of impact on investment, I think that if a trade deal, first of all, if a withdrawal deal is reached by the next Conservative government, assuming that the Conservative Party wins the election, then of course there might be like a positive knee-jerk reaction and an immediate relief, and some investment projects that were held back because of uncertainty might be unlocked. However, I'm not really holding my breath for like a revolutionary turnaround in the business investment picture. It's worth reminding that according to most estimates, adopting different points of view, business investment is probably between 11% and 12% lower compared to a no referendum scenario. So it will take time and certainty, which I think is still some way out in the future, to really make up for all the lost investment in the last 3 years.
I'll give you one source of encouragement, though. sometime by 1994-5, when the pound was stable and beginning to go up again, I was asked how high I thought it could go. And I dreamt up some number that was vastly lower than where it got to over the next 5 years. So, you know, if you took a really optimistic view of life, we're either bumping around along the bottom in a range in value for sterling, or something will come along that we can't think of, a better central bank structure, better fiscal monetary policy mix, things going wrong elsewhere to make it more valuable. So there is a sense that here we're in a mess.
Well, the Conservative Party or the hard Brexiteers tell us that a weaker pound is good. It's going to help the economy and help with the recovery, and eventually it will self-correct. Can you help me with maybe the bull case, the devil's advocate case, Jane?
I'm afraid not. I mean, certainly, I mean, if you look at the export data that we saw today, it did appear to be a little bit stronger. You know, we've seen the performance of the FTSE 100, not maybe in the last few weeks, but certainly bolstered because of this apparent reaction because of a cheap pound and exports. But it's very difficult to see through the weak investment that we've had for a number of years now. The weak investment generally means lower trend growth and higher inflation because we meet capacity constraints sooner than we would do otherwise. So we've got an environment, because of the weaker investment, that you have lower growth and higher investment potential. And it's difficult for me to see beyond that. That is not a good scenario. So for me, that's the economy which I think we've given ourselves.
Yeah, self-inflicted to a certain extent. I wonder, maybe we can look at the other side, particularly if we're thinking about euro against sterling. Silvia, how do you think that Brexit, among with everything else that's going on, is going to play out for the European economy?
According to most estimates, I've seen around like a particularly hard form of Brexit would be clearly detrimental for the rest of Europe. It would be probably take off a bit, about 0.5 percentage point growth in the Eurozone. However, I mean, the biggest negative impact would be really for the UK itself. So, of course, there is like an incentive on both sides to reach a good withdrawal deal and also a good trade deal afterwards, so in the second phase of Brexit. But still, the UK has probably more to lose from like a loser relationship with the European Union.
And I guess the other problem is forming those trade deals takes time. It's not necessarily a done deal for Europe or then for the rest.
So recently we have had the instance of Canada, and it took 7 years for Canada to reach a trade deal with the European Union. Now, one can argue that the UK probably starts from a better point because it's already aligned in terms of regulation, it's closer to the European Union, there's like a tradition in dealing with each other. However, I mean, if you start from a particular acrimonious situation where there's bad blood between the two parts, I'm not really sure whether it will be easy and fast to really reach a good trade deal.
Yeah. Kit, we heard a little bit from the Bank of England last week. There were a couple of dissenters on the Monetary Policy Committee that maybe caught some of us by surprise a little. How, in this pretty gloomy scenario that the three of you are pointing towards for the UK economy, how do you think the BOE reacts, and how does that then play back out for the currency market?
Look, I think most people are shifting from listening to the Bank of England sort of story for a while now about the need for the next move to be higher, looking at the global economy and saying the next move is going to be a cut. They will cut interest rates at some point. They've been taken by surprise by the pace of all of this, but definitely, and I don't think a cut somewhere out there is going to have a big foreign exchange impact. I think the bigger questions, the other side of an election is, everywhere, and this comes to Europe as well. When I'm not on continental Europe, it's pretty clear that Europe desperately needs a change in its fiscal monetary policy mix. When I get to Germany, no one seems to believe that there's any need for this at all in a million years, and so I come back. When I'm in the UK, we're going to get a change in the fiscal monetary policy mix, almost regardless of which party gets involved. The only thing that slows us down is if we get a sufficiently messy outcome that nothing can happen. but we're going to get a fiscal response. So although we might initially get easier monetary policy, we will start moving in terms of easier fiscal policy, and that will eventually, that'll limit how much rates come down. But again, big question, you know, won't there be a recession in the United States in the next 18 months? Everything else falls from that.
And Jane, your base case is that there will be a recession in the US next year.
Our base case is that there will be a recession in the US at the second half of next year, and therefore, consequently, you get the associated headwinds, which does then bring the view that we're more likely than not to get an interest rate cut than a hike in the UK. But then layered on top of that is the fiscal response, and I think it's perhaps more interesting now, I think, for the gilt market perhaps than sterling, because clearly you had the warning from Moodys on Friday about UK borrowing. You've had a similar warning. You had the Chancellor's plans on investment not going down very well at the IMF last month either. So clearly the situation in the UK is, well, everyone wants to borrow, the Lib Dems, the Labour Party, the Greens, the Conservatives, to take advantage of record low borrowing rates. But of course, one reason that borrowing rates are so low, apart from, of course, international factors, is because it is considered that the government has a prudent plan, which may not necessarily be the case if you read some of the rhetoric from Moodys, etc. So it is quite interesting that the fiscal implications of whatever government it might be, given even if we have a hung parliament, even if we have a coalition, because they all want to spend, it is very likely to get so that we will have extra spending. You know, that will be a boost to growth. But it clearly complicates the outlook for the Bank of England. Yeah.
I have a funny story about the Moodys decision on Friday, where my colleagues came over to me midweek and said, "Do you think Moodys is gonna do anything?" That's not in the middle of an election campaign. Definitely don't need to worry about that. But have a template ready just in case. So it's a good job that they were well prepared for that coming. Sylvia, do you think the gilt market can take the kind of fiscal spending that we're seeing being bandied about? Okay, so some of it might be a little bit of hyperbole for one party against the other and stuff like that, but as Kit and Jane were saying, it feels like fiscal stimulus is coming down the pipeline one way or another. Marcani reminds us often that we rely on the kindness of strangers to help plug the UK's deficit. Is everything going to be okay?
So that's a very good question. I have to say, as Jane said, there are some international factors that are keeping interest rates low. Interest rates have been trending down for decades now. It's a fairly established trend, and that's probably driven by some structural factors. So at the end of the day, interest rates are really the result of savings and investment, how they balance, and it looks like there are too much savings around and too little investment. So in a way, it's not just central banks and keeping interest rates low, but it's also this balance between investment and savings. And then I'm not sure that it will change going forward. So from this perspective, there's probably an opportunity for the UK government and also for other governments to really try to take advantage of the current rate environment. It looks like fiscal stimulus is on its way, irrespective of the party that wins the election. The Conservative Party has like a fiscal package of £22 billion, so 1% of GDP. The Labour Party proposals are even higher, £55 billion, which is like 2.5% of GDP. So in all scenarios, I think fiscal stimulus is coming. It's true there's a risk that financial markets take it negatively, but even there, I think that now financial markets are really looking for the next big game for growth. Monetary policy has arguably been exhausted, and now there's a lot of hope on fiscal policy. So again, there might be an opportunity for the government in general and the UK government to spend more.
And if the BOE ramped up QE again to facilitate that, that kind of fiscal plus monetary...
More coordination between monetary and fiscal, that might be the story.
Is that a good idea in the long run or a dangerous game?
I think there are dangers clearly. I mean, we've seen like decades of remarkably low inflation and stable, let's say, a stable economic environment, and arguably that's also due to central banks' independence. And of course, in a scenario where you have closer coordination between fiscal and monetary, that might be really missing. So yeah, we'll see. It's a challenge.
Have you looked into that at SocGen?
Yeah, look, I mean, the first thing I'd say about the gilt market and all of this is that, you know, if there were, by some strange chance, a generation of baby boomers who might need annuity-like fixed-rate products as they reach the end of their working lives for one reason or another, that maybe slightly less negative real interest rates might be a cracking idea at the long end of the curve, which is just a way of saying I would be shocked if we couldn't sell a lot of gilts without yields going up very much. I mean, in that sense, the way the world is, you know, structured, we've starved savers of real yielding fixed assets to go out and buy. So that's the least of my problems. The greatest of my problems is the idea that we might, in one country before others, explore how much you can merge fiscal and monetary policy and play with the meaning of money, and, you know, trying to challenge the world about its value. Whoever goes down that path first is likely to have one of the world's softer currencies for a while, because however much you want to buy into the idea of MMT, it's going to be one heck of an experiment to make with the country's money. So I'd rather hope that, you know, a small country with a whacking great current account deficit didn't actually go down that route first. I think that would probably put me off. But that aside, look, you know, the idea that we're back in the 1970s and we issue a bunch of debt and send ourselves into a screaming disaster in terms of rapidly rising bond yields because inflation goes out of control, and I mean, maybe sort of, you know, I suppose I could write a particularly Jeremy Corbyn article for myself about it, but that aside, I just think it's fanciful.
I do think that the UK would be an interesting place to do that experiment of all of the countries, considering what the next steps are. In general, the interest rate environment that we're in, what has that done to FX markets, Jane?
Well, I mean, the interest rate environment, I think, is a function largely of the savings glut. And one thing that I think is really quite interesting about the savings glut over the last 20 years is the proportion of that coming from Asia. So we've had a huge growth in emerging markets, a huge amount of savings now coming from emerging markets. And I think that this has really altered the trend for the dollar. So, for instance, if you take a country like India, and you look to see how much oil is being imported by India, you begin to get a taste of how much dollars is needed in a country like that. And then, of course, India is obviously not the only emerging market country looking for dollars. If you think about dollar-denominated debt, if you think of the fact that the US dollar is on, according to the BIS, it's on one side of 88% of all over-the-counter trades, you see this huge demand for the dollar. And I think what's happened because of the growth of emerging markets, the savings glut and demand for the dollar, you have this link now between emerging markets and the dollar, whereby the dollar trades like a safe haven when money's either flowing out of emerging markets or back the other way. There's quite a nice inverted correlation between the dollar index and MSCI emerging markets index, for instance. And what I think that means is that these structural changes in the demand for the dollar's dominance in the payment system, everything else, means that even if the Fed cuts interest rates very aggressively and weakens the dollar next year, I think probably the dollar will still be stronger than most people expect it to be. I think there's an underlying demand for the dollar has shifted in favor of the dollar. And again, this is a function of the savings glut, which has sort of brought down those interest rates. Negative interest rates, again, I think this is a function of the savings glut. As Kit was saying, there's just too much savings. It's got to go somewhere. And I think that is how I would sort of see this trend in very low interest rates really manifesting itself in foreign exchange.
So maybe we have the the good news case for Brexit after all. The Global Savings Club can rescue the UK and bail us out. It's interesting that you talk about the rise of Asia. Maybe kind of in the last 5 minutes or so that we have, we could talk a little bit more about the City of London and FX trading. I feel that that's kind of interesting. We have an Italian working at a UK company and two British people working for European banks.
Irish.
Irish. Oh, I beg your pardon. I do apologise. Makes it better. You know, I wonder, I will start with you, Silvia, how you see things changing in the City of London, how you see Brexit. Is it a threat to currency trading and to the existence of the city?
So I think in the short term, Brexit shouldn't change much for the city because basically in the UK and in London there are some big advantages in terms of legal system, language, time zone, also access to talent and expertise for trading in general, FX trading. Mm-hmm. So I think in the short term there are some advantages that should protect London. Of course, longer term, I'm a bit more concerned and I have the impression that there's a bit of complacency around about this established role for London. Yeah. At the moment, well, there are some estimates around suggesting that up to 30,000 jobs might move out of London if basically banks based in London lose their passporting. So basically the right to sell financial services to the European Union. And that EU clients might move up to 1.8 trillion euros back to the continent, basically. And if that happens, of course, the system, the ecosystem that is supporting trading might really
because it's not
disappear.
Just the banks, it's the legal systems and the structures and all the regulation that goes along with it as well. And yet the FX industry so far has been growing?
The FX industry is growing. London's share is holding itself comfortably. And I don't know. I mean, I think London's a fantastic place in the sense that it reinvents itself. It's that properly global cities are not that common. I grew up in Paris, which I don't think is properly global as a city. It's a French city. It's a beautiful city, but and there's not a lot of choice of employers if you're in our industry in Paris. My first job was in Frankfurt, which is a small city by anybody's imagination, especially when you're 23. I've worked in the States, which is definitely very American, not global. And London's completely different. Where we're sitting is underneath what used to be a Japanese bank and a Japanese restaurant next door to a nice pub called the Mithras, as far as I can remember. And all those Japanese banks have all vanished, merged themselves down. I arrived in the city a little bit before Big Bang. We did Big Bang, and then we blew up all the post-Big Bang big banks pretty efficiently. And yet the whole structure survives because we're in a great time zone. We have a language which we should look after, and the foreign exchange market is just the most global market, and we can trade it 24 hours. You have panels here of people, doing foreign exchange in a completely different way from when it was mine yours between Japanese banks 30 years ago. So I'm massively optimistic that the City of London will survive. Massively pessimistic in the sense that it'll sort of kick out a few dinosaurs before it's gone, and I may feel more and more like one. I would have loved it if it could have moved itself to places that would have been fun to live for a few years every now and then. I just don't think that's going to happen. There's a ton of places in the world where it'd be great fun to move the foreign exchange market. But I think it's stuck here, I'm afraid.
Stuck here. Jane, a few words maybe on that subject.
Well, I read something this morning that said that outside of China, I think the UK's got the largest renminbi trading, and this is obviously a post-Brexit environment. And again, the last BIS report said that London had gathered market share relative to New York in foreign exchange, and obviously that's since the Brexit vote as well. So it seems that London has expanded in the last few years. Clearly, as Kit said, we've got the time zone, but we've also got a huge amount of the right staff in London. And that means for any firm that is thinking about moving back to Europe, it might be difficult to do because the staff are here. It might be easier to hire the expertise here. So I hope it stays in London. I hope London continues to grow. Clearly, Brexit, though, is a risk. And I think most of us working in the market are a little bit fearful of that.
Fearful, and we're going to be very poor if your prognosis for the economy and the currency maybe works out as well. Good. I would like to wrap things up at that point, but I would like to say a very big thank you to my panel. I hope you all join me with a round of applause. And so that concludes our programme. I hope that you've all enjoyed this afternoon's event. Once again, we'd like to thank our sponsor, Swissquote Bank, for helping to make this afternoon possible, and our speakers for sharing their insights and joining us on stage. And a reminder that you can continue the conversation on Twitter using the hashtag Leading Forex, along with the handle @Bloomberg Live. And we'd appreciate if you can take a few minutes to open up the app and leave your feedback with the details behind me here. For a list of upcoming Bloomberg Live events, please head over to bloomberglive.com. And now we'd like to invite you to join us for a drinks reception, what will be served outside this room. So thank you very much, everybody, for coming. Thank you again to the panelists.